Got a new intro.
Woo! Well, beat on that one, like feels intense. Feels like something's going on in the markets. I don't know.
Oh my gosh. Well, has it been like our regular roller coaster of a ride these days or what?
I'm going with it. It's been a roller coaster for sure. It's been interesting.
I mean, you look at the news this week and man, I mean, you got another possible bank failure, Pac West.
Sure. Well, 10% of deposits this week alone they've lost.
Oh, yeah, they reported to the SEC is like $9.3 billion. Dollars.
That's
What?
nothing.
Yeah, I don't think I'm going to open an account there.
Yeah, I'd strongly suggest you avoid. I'm just curious, who's going to get this, bailout fund? Will Chase, JP Morgan win again and get this awesome scenario? Will Bank of America or Wells, will they be the ones to ride the storm and save the day on that
Oh boy, I don't
deal
know.
from the government?
It's not like they can break the well, yeah, they can break the law and have a bank own more than 10% of the deposits. So, you know,
Um,
but hey, no big deal. It's just the law. Um, we did get some really good news yesterday, though, in that the FHFA said
yeah.
no more to the price adjustments for debt to income ratio.
Yeah, for the LLPA. This is huge. And I don't think a lot of people I've seen a lot of people post messages, but the context of this is I always joke, why is it so important? I said, there's nobody, especially in this market, that's doing loans where their debt to income ratio is below 40%. And with those
Yeah.
LLPA, they were going to be hitting, and there were some significant ones on that debt to income where it was going to have a big impact for borrowers over that 40%. It's that was one that I was we were pushing, and there's a lot of advocacy work with AIM on the association I'm part of, and really pushing. A lot of organizations really followed in, and I don't know if you caught this, but FHFA they actually said that before they make future policy change, that they're going to go to the public first to get insights. And I thought that was really interesting. I was like, what? This is actually maybe a step in the right direction of
Yeah. Why would
hey,
you not go there to begin with the people
right?
who do it every day?
Exactly. So I was like, that was a huge one where I was like, if that little bit of adjustment was what they needed to improve the process and to actually make sure they're not doing things that are going to completely derail, markets, I'm happy with it.
Yeah, yeah, I know it. I know the Mortgage Bankers Association was big on it, that it was just going to be so complicated that, you know, I mean, what happens if, in the middle of something you go from a 45.01 to a 49.99 and you've got to adjust again, and the rate all of a
Yeah.
sudden
And,
changes and, you know,
and now they don't qualify at all.
yeah, yeah, I could
Right?
have seen that one becoming a complete nightmare for you
Oh,
whatsoever.
and we talk about insurance and all these things that have an impact that it's hard to there's so many things that as you go through the transaction can adjust it that it could have been a complete nightmare. So I was really happy that they did away, and it's good for the consumer that they did away with it.
Yeah, yeah, it will be long run. It will definitely be much better for the consumer. Well, I know you and I have been talking about this, and you kind of wanted to hit this today because one of the main things is just understanding what you guys have been going through as far as rates. And this is just the past month since basically
Yeah.
April 8th to today. And, you know, when we say a roller coaster, I mean, it
That's
literally has been a roller coaster up and down, up and down.
Yeah, and that's the hard part is, and if you notice, the adjustments is, they're talking about right now. They're I've seen news articles. They're rates are nearing the lows for the last 30 days, and you see we're on a downward trend. Absolutely, it's good news, but it's kind of just, if you look back over the last 30 days, there hasn't been enough that has justified this roller coaster in my mind. But you get so much fear, you get a little bit of that fear factor in the markets and the capital markets of the people that are doing bonds and controlling all this stuff. And they just don't know where to go. You see positive news and we see spikes and then you just see it fade away, which is what you can see. Is every time we peak up, like, we get down, we jump right back up, and then we go back, rates go back down, and it's back up. And it's been just an absolute, and kind of the way I've almost felt is like there's these knee jerks of, oh crap, rates are too high, let's drop them real quick, right?
Yeah.
And
It's sometimes it's literally within hours.
yeah.
Unemployment numbers come out. Boom, they go this way. Oh, wait, nope, coming back down here. Then, we got possible bank failure here. Then we've got the debt ceiling limit here, and we got this here.
Yeah.
And no wonder everyone's going crazy. I mean, it's just no one knows which way to look.
Yeah. One sec. Was that
at the closing table?
Nope, we should be good on that one. I don't even know if my phone. I'm so sorry. But we literally hit this, and you go into these different pieces where it's just been absolutely kind of nobody is willing to, like, things that should move rates in the right direction hasn't responded the way that we should see them. Things that should move them in the different direction, we're not seeing, and we're seeing that the hesitation. You got West right now. You had the other ones from and then you have all of these action items that are occurring, and it's almost like we're seeing a lot of institutions, kind of like we're seeing the bond markets, and we see this where investors that where they put their money, they're like, I don't even know where to put my money, right? Like there's
everyone's. I mean, one of the big things that everyone's nervous about is the debt ceiling.
Yeah.
And I don't know if you looked at the numbers, but I think within the past week or 2 weeks, the 1 month bond yield has jumped well over 5% because no one's sure after a month that the U.S. is going to have the money to pay the bonds that they're possibly going to default.
Yeah.
And I was looking at basically like the checkbook of the U.S. and we had like $188 billion left in the Treasury checkbook and burning through roughly about $25 to $35 billion a day. And you're looking at that going, well, that gets me only to about May 25th.
Then be like, are these the people that should be? Apparently, they're not very good at budgeting. I always love those where they take the federal budget and break it down into a household budget and get rid of about 2 billion zeros from it. And we're not very good at handling our budget as a government, and it's really scary when it's like, all right, they have so much control over what everything else happens, right? Mm-hmm. And you hear things like, the 14th Amendment, right? Like being and Biden talking. I was like, why are we even teasing these things? We shouldn't be talking about being able to supersede that debt limit and invoke the 14th. And I'm like, no, like this is all like, no, let's pause. Like, that's not good. Like, we can't even get student loan forgiveness.
It never addresses the real problem is that we spend a heck of a lot more than we take in.
Yeah, we got a spending problem.
Yes, that's it. Both sides. Both sides do. You know?
It's really easy to blame the other side on why we have issues with their budget while we still spend on our side, right?
Yep, exactly. It's like, at some point there's got to be one adult in the room who says, no, you can't have it.
I thought we had a bunch of adults in the room, but clearly we don't even have one.
Yeah, I mean we don't even have one. So that's where our markets are today, just up, down, up, down, up, down. So it gets to be a lot of fun, for us watching the news every day. Sorry about that little glitch. Poor Joe, I think, got struck by lightning over there, and nice thunderstorm. So we're going to continue and go through the numbers for the week. So overall, great week for the Orlando housing market. Very steady. Continued to be over the 400 homes per week sold, actually 440. And then the inventory actually, believe it or not, went up a little bit. So we're up 27 homes, but got a feeling that may dip a little bit. But if we can stay around that 3,500, not go down, and slowly start to see a creep back upwards, that'd be wonderful. Especially with school being over here within the next week or two. That's when the families really get out there, really start looking, trying to get situated before the school starts back up in August of this year. So that's all good. Condo market, again, very steady. Actually, 3 more homes sold this week than last week, and their inventory went up a little bit as well by an additional 31 units. When we get into our numbers overall, single family, you're seeing that, again, we're staying consistent with the final sales price to the final list price. We're sitting at that 98%, but within the key market of 300 to 400,000, you're almost at 99%. So there's not a lot of wiggle room in there to negotiate. Right now, it's leaning towards the seller, and the buyers are kind of having to do what they need to do to get the home. And we are getting into some multiple offer situations again, but not seeing the craziness that we saw previously. But you are seeing people going, $5,000, maybe $10,000 over. Not too nuts, but they're going. Some of them are going over. And here we see it graphically that the consistency, the median price of the 400,000, and the average price sitting right around 500,000. And again, since really February, and everyone was complaining about the price adjustments, that's kind of where they started being absorbed in, is you've seen a consistent level of about 400 homes or a little bit higher per week sold within the Orlando market. This is the concern still, though. We are 23% down since the beginning of January, but we hit a couple level spots here early April, and here the end of the month, we saw a little push back up. Hopefully, again, we can see that continue, help make it more of a balanced market to where the buyer does well and the seller does well. When we get into the condos, same situation overall. This I thought was kind of interesting. In the 400 to 500,000 pricing of condos, you're at 99.31% as far as final list price to final purchase price. And then also in the 250 to 300, days on market is actually dropped to 25. So these are the red hot condos that are currently being sold in between that $250,000 to $300,000 market. Reason being affordability. With the current interest rates, they're still affordable, even with HOAs that might be a little bit higher in that $300 range. And here we see the sales for the condos. Again, staying well above the period average of 127. So that's a good sign. The condos are continuing to sell as well. So overall, our market, like we've been saying the past couple months, consistent, very consistent. So if you're looking to buy or looking to sell, be aware that there's not, as a buyer, there's not a lot of room. Your inventory is not the greatest, so take your time. The average days on market, it's sitting for single family homes right at that 45 days. So not all of them are selling right away. If they're priced right, prepared right, and presented right, yes, they are. But there's still some wiggle room in there. And then sellers, now's with the inventory as low as it is, it's a great time to sell. So if you have any questions, always feel free to reach out. Please remember to like and subscribe to these videos, and we will see you again next Thursday at 10 o'clock. Have a wonderful day. Bye-bye.